Hey guys, Freaky Finance here. This week we're gonna go into REITs again. We've done a few on REITs, I think, over the past years. This one is a fun one. One of the themes, maybe you guys have picked up on this by now, but basically I like to go over things that are selling off and then I try to buy them. Usually where the fire is. So this the theme of today. So basically, here's a company that went from, call it $20 a share to $1 a share. Did I think the company should have sold off? Yeah. Do I think it should have sold off 95% when they had enough cash to make it through? No. So that basically things that are looking like they're bankrupt, and you go to the balance sheet and they're like, okay, no, they still got time, kind of thing. This was a riskier one. Roku was another one. We talked about digital advertising turnaround with Meta. It's the same idea with Roku. It's just all in the scatter market for advertising. Advertising was very cyclical, got pulled last year, market overreacts. So far, what I'd say is that the market's, whatever is currently happening, the market's pricing the current effect into perpetuity, regardless of what the actual truth may be. So whatever is currently happening, the market just overweights that and just pushes it into infinity. So if things are currently good, it's going to push it to infinity. If things are bad, it's going to push it to infinity. And it's making these big swings in stocks. Even Spotify, Freeport during COVID. I remember doing that video. And basically the world was shut down. Why would you buy copper when it's a proxy on the economic environment? Well, basically I figured, well, eventually the world's going to turn, right? Chartwell occupancy for senior living will never recover because of COVID. That turned out to be false as well, but it's never technically back yet, but it's improving. And people, when I bought this, was like, no, it's never going to come back. I'm like, no, people need to be there. Suncor, same thing when oil was at 0 to 30 in that time period when I did the video. It's the same idea. Oil companies are doomed, it's never going to recover. Well, and sure enough, it recovers. So now we're in another one. This one is a strong one. It's one that I've thought about for a while, and I'm starting to finally find some entries in the certain stocks. So I do own Allied Properties Real Estate that we're going to talk about today. And I do want to point out one of the things about the fires is you never know, eventually you're gonna get burnt in a few, right? So I wanted to put, it's not like I always am right? Though I do think I'm right on PayPal, but we'll see. I'll probably add to that at some point with these other ones up here. But anyway, that's kind of the theme and how I want to structure today. Maybe before we jump into the numbers, let's just talk about the properties first. So really it's a Canadian REIT. Largely Office REIT, so Office is kind of left for dead right now. No one wants to touch it because right now the view is working from home is here to stay, and that's partially true. But again, the market's priced in the decline into perpetuity, or in my view. So it's, again, a half-truth that's being punished overall. You can see it's largely in the GTA area, Toronto, and a bit of Montreal as well, and some on the West Coast. There you go, my head was in the way. You can see now a large percentage of the square footage is in here. Canada's had a lot of immigration for the last few years, and it's largely going in these places that are warmer, which favors these things over time. Again, this isn't residential REIT, it's an office REIT. But what we're seeing is no one's building more office buildings when no one can even lease them. So what's happening is they're converting the office buildings into multi-reses to try to give people a place to stay. Could go into more of them, but if you guys ever wanted to, you just go to their website and click on the properties and see them. But you can see a very dense book inside this area near Billy Bishop Airport. All right, and to Americans, it's just a hop skip away from Buffalo. All right, let's get into it. How is the REIT structured? So they have the office part, the risky part. They have a data center that they're currently selling. This is one of the reasons why I'm doing this video for this company specifically, because there's a lot of REITs that have sold off. So one of the reasons I'm trying to find ones that have a catalyst for improvement. And they do have some retail and parking, but really you can see it's dominated by office. Who are their tenants? So whenever we do a REIT, you always gotta look at the key tenant risk. There isn't a big tenant for these guys, which is kind of nice. They do have some of the tech guys that are cutting their office footprint. And we're going to see, like, there is some truth. There is a reason why this is cheap, right? Because people are cutting their office footprint. It's one of the ways to save money. And they're finding they don't need it as much after COVID. So there is going to be this work from home shift. It's just that how much of it is already priced in, how much of it is overpricing in. And we'll see that play out over time. So anyway, I just wanted to point out here that there's no one over 5%, no one over 10% for this rate. So there's not a huge key tenant risk. So it's not like someone's going to move and they lose 20% of their income overnight kind of thing. We'll go into these metrics after. I have my own spreadsheet for this where I kind of track what I want to track. But the balance sheet's fairly good. It's 36.9 total indebtedness. If it sells the UDC, it should go down to about 32 or 33. So fairly low debt to the assets on the book, which is what you need for something that's riskier, like going into office when no one wants to. When work from home is a very common trend. And this is just the rental values for the square footage. So you can see a whole lot of the total leasable area is definitely Toronto and Montreal focused. And here they're trying to also show that they are superior to the market in terms of occupancy. But the bear case would be like, well, it's going to revert to the market occupancy. But they're trying to say that they're better in most places. Here's just a snapshot of Toronto buildings for the people that live in Toronto. But for our purposes, we don't even need to go here. But they are fairly dense. The geographic footprint is very concentrated in this GTA area as well as in Montreal. So one of the things that I'm excited about is this company has a history of performing well and operating well. So you can see the annual distribution per unit as well as the NAV, so net asset value per unit, has just steadily gone up. A part of this is the appreciation of the property over time. Property generally does appreciate over time, over a long enough time horizon, especially as the amount of properties lags the population. Obviously, it's very location specific, but we've seen a trend to urbanization for a very long time. So the more urban your properties are, the more they've appreciated in value. Again, also inflation, property generally hedges that over time as well. How's the share price doing? Well, the opposite. So that's why I'm doing the video. So we can see pre-COVID, this thing was right around $50. It actually hit up to 60 or almost 60 at one point, pretty crazy. And then during COVID, it snapped down, even worse. And then to the vaccine, it rallied a bit. And then when the work from home narrative really took hold, and people were like, oh, why own office when no one's going to be there for the occupancy? This thing got shot again, and now it's down to $21. So it's had a fall from 50 to 21. Call maybe the real value might be something in the 40s, so it's gone from 40 to 21. So it's about half off from my point of view. Because I do think there is some impairment that'll never get back to these values, but that's just my opinion. Let's jump into, let's talk about this. So this is the reason why I'm picking Allied for the video today and why I own this one over other ones so far. There's a few that I'm looking at that look interesting. I'm just trying to see if I can get a better price because this thinking is very strong right now. So I bet you I can get some good prices and REITs for the long term here. Especially ones that don't even have that much office footprint but are selling off like they are office footprint heavy. So this is one of the things that's happening is they're selling their urban data center portfolio to a Japanese company for $1.35 billion. Importantly, $118 million over the IFRS value. So right now, a lot of reasons why they're selling off is because their market's basically saying we think you're going to have to write down your assets by quite a bit. They're worth less because you're going to have less people in them to occupy to make you money. But importantly here, you see for the urban data center, you're getting a value that's above IFRS value. So not only are they not writing it down, they're actually going to have a gain on it. More importantly than that, even though the market's already pricing in about a 50% loss on all properties that they own, right now they're showing that they're going to have about a gain of about 10% on a tenth of their properties. So anyway, and more importantly, what they're going to do with that cash is they're going to pay down the higher yielding interest expense that we're going to talk about. And one of the reasons why the share price is cheaper is because the FFO is getting lower because of the interest expense. And FFO is and AFFO are the main things that you got to look at and read over time. As well as a bunch of other things, but that's kind of my first cue when I look at something. Anyway, I think this is just more of the use of the proceeds. Allied leaves approximately $1 billion to retire debt, and the balance is to upgrade and development activity. I do want to point out here that the sale results in a significant increase in taxable income because of the gain, requiring Allied to declare and pay a special distribution to unit holders by the end of this year. So we're going to see a special distribution because of this sale of assets, which will be interesting to see how the share price reacts. That might rally going into it and sell off as actually pay it. It's usually what happens, but we'll see. I like these plays. One of the things we should be seeing, this is what I want. This slide kind of sucks for me, is I want the cap rates to go up. I want, they have gone up, but I want the companies to report them going up because that's what hurts their current values of the properties more. And cap rates basically are R minus G. So as interest rates rise, basically you're supposed to be writing down your fair value of property assets. And there's other things, like a lot of banks aren't even lending to office right now. So the cap rates are going very high because no one wants to be invested in them, because that's how bad the narrative is right now, that office is dead forever. And so I was kind of hoping that they'd increase their cap rates more. They really haven't. So that's something that could happen, is they're probably going to have more fair value investment losses. And I think they will, especially to offset this gain they're about to have for the urban data center, right? What else is there? Credit ratings. So again, we're talking about consensus view, very narrative on office. Here they are taking down the numbers after the narrative is in hold. That's usually what rating agencies do. They leg it on the way up and they'll leg it on the way down. So after things are very bad, they'll say things are bad. I remember in 2008, 2009, especially 2009, they were still writing down the ratings after the market was already rallying. Right? They're always late, rating agencies. They're never early and they never add value. But I like this one because it kind of tells me the consensus is here. And part of it is true. I'm going to go through the numbers right now and you can see that. Overall, on the operating side, they're actually up year over year. A part of that is their in-place rents are lower than market rents as they reset higher. They're getting more money. Importantly, though, even though operating income was up 3.1 million, their interest expense was up 7.4 million. So basically, nullify the effect and made the company worse year over year. Part of this is a floating part of the debt that we're going to talk about that the company's planning to pay down with the proceeds from this UDC portfolio. As far as what they can control, the general admin expense is down year over year. They've already cut costs, specifically I looked at, and it's in salaries. They do have some offset with interest income, but not enough, only up 2.8 million versus the 7.4 million interest expense. And then you have your noise, which is your fair value gain or loss. So as a REIT, you got to mark your properties up and down every quarter. Most REITs will be marking them down as interest rates have risen. And that's what we'll continue to see, I think, over time for now. And that's kind of what the market's probably pricing in, is that the unit price is at 21 and they're claiming their value of their assets is worth about $50 a share. The market's already discounting it quite a bit. So they're basically, if I was to say this, the market is basically saying the property value is now worth 3.3 billion less year over year. The equity used to be worth 6.2 billion. Now it's seen as less than 3 billion. So I think here you can probably see it's an obvious overreaction. We don't think all the properties they own are down 50% year over year value, especially when they're selling 10% for a 10% gain on what they have on their value on their books. So it's a very interesting time. The share price is down more than 50%, hence the video. I always like to look at things when they're getting destroyed. Here is the investment property assets and the held for sale ones, HFS. And you can see the total there is 11.2 billion. Importantly, the debt's only 4.4 billion. So they have over 11 billion in assets and they only have 4.4 billion in debt. So that's very nice. And importantly, they're planning to pay down about $1 billion of the highest interest floaters that they have. That's one of the reasons why the interest expense is up so much year over year, is because of the floaters. And I can show you that here. So here you have the debt. So out of the 4.4 billion they have, you can see they have very little in mortgages payable. So very little in secured debt. They have it all in unsecured and some senior unsecured as well. But importantly, you can see the revolver here is about 675 million bucks. And what they're going to do is pay that down because that's the one that's floating the most and hurting them the most. And then how do I know that? You can go to interest expense and you can see that here, that of the 7.2 billion that we saw interest expense go up, basically. Yeah, 7.4 million, sorry. You can see that the lion's share of that is the unsecured facility. So what they're going to do is pay that down because that's obviously the highest interest expense at this point. And I'm assuming, I don't even know if they have mortgages payable or not on this, on the UDC, but they'd have to pay that as well. But anyway, you can see that I'm trying to say here's the balance sheet's pretty strong. And they're about to pay down their highest cost of capital currently. What else is there? We have seen the FFO and the AFO decrease year over year. And again, that's the interest expense hitting them. I wanted to put the adjusted EBITDA here. I usually don't for REITs, but I wanted to put it here just to show that what's happening is that you can see that the operating income's up year over year. And they did cut costs on the G&A line, which are things that would affect the EBITDA. But interest expense obviously doesn't hit EBITDA. EBITDA is before interest and taxes and depreciation, amortization. So you can see that the FFO is going negative year over year, whereas the adjusted EBITDA is going positive. So basically you can say that the whole decline in fundamentals, the slight decline, is from interest expense. Now it's not all from that. We also have occupancy down. And that's the big one. So this one, basically you need this trend to go back over time, back over 90 ideally. And that's going to be the hard thing to know how office plays out overall. Like, how much does occupancy go down in the space from work from home, right? Importantly, we can see the average in-place rents are going up. So rent is still increasing year over year. So anyway, you can see the net asset value per share is starting to decline as we're writing down the property value. But it's only declined 40 cents versus the 52% that the market price has declined. And so you've seen the NAV discount blow out from minus 12 to minus 58. So we're getting a very attractive proposition on the property value. So it's kind of telling you the market's left us for dead. Doesn't think they're going to make it, or at least properties. Or you could be viewing like maybe they think occupancy is going all the way down to like 70% or 75%, right? And then you could make the case that the debt's actually high if the property value is going to get cut in half like that, right? Right? If they have 11.2 billion, but really they only have 5 billion, right? And you still have the same amount of debt. What else is there to say? Talked about the occupancy going down. Now they have said that they're planning to get occupancy back over 90% by the end of the year. I'll read that to you once I go through the call notes real quick. And then the last thing, the dividend yield is quite high. So when you look at it, it's around 8.5% right now. Whenever things get that high, you're usually worried. In this case, it's high because the price has been cut in half, the unit price. I want to make sure that the current dividend that they're paying, about 57 million a quarter, is covered by the FFO. And you can see that even accounting for the maintenance and stuff like that, you're still at 75 million a quarter. So they can still cover the 57 million in dividends that they're paying out. REITs have to pay out almost all their net income in dividends. Stay tax efficient under the REIT structure. What else is there? Here is just another way to show the interest expense per debt type. And you can see unsecured facility that they're going to be paying off with the data center portfolio is the highest one there at 6.24. It's basically been floating up with interest rates going up. So that's the one they're going to pay off, and that should help stem the tide there. And then you have in-place rents. So this is them basically saying that the expiring rate that they have is less than the renewal rate that they're going to get. So they're going to capture the spread. They say basically 64% of their percentage square feet that they have is under or above in-place rents. So basically they can take it up. They have about a third that are in place, so they're not going to make any more money when they renew. And they have 3 that are actually down year over year. Relative to the market in-place rents. So that's what they argue anyway. So if occupancy were flat, we would see these things roll and slowly increase the operating income of the REIT. This is another way to show the delta between the in-place rent and the market rent. And you can see basically they're claiming each year that they are under the market rents. Though there is it's important to note that's narrower here in 2024, which is interesting to point out. It could mean more headwind if this drops a little bit. And then they're resetting at a lower rent, as that would be another headwind. What else? Let's just quickly jump into some things that folded up in the call. This is on Q1 notes. This is them talking about the interest cost was up entirely due to variable rent debt. They plan to retire the variable rate debt fully and increase our liquid materially with the proceeds from the sale of the UDC portfolio. So that's why I'm thinking they're going to do it, because they've said it over and over again. Here's them talking about the occupancy, and they said, well, we're certainly projecting an increase between now and the end of the year. That hasn't happened yet. Important. That's one of the reasons why the share price is weak, or the unit price rather. They said they'll be in the low 90s for sure. Currently, I just showed you on this that they're only at 87.6 still as of Q2, so they have some work to do here to actually get that over 90%. If they do, that will help. Instead of seeing the declines in FFO, we might actually see break even despite the higher debt load, or higher interest rates rather, on the interest expense. And then finally, you have basically talking about the spreads. Basically, they're saying they're coming in a little bit better than what we thought. And again, a lot of the deals, and then he's basically saying, no, it's not everywhere, it's just in Toronto. But they're seeing some better rents. So anyway, we'll have to see what happens. It's definitely a fun one. It's definitely the theme of like running into the fire, right? When there's always some truth to the right. There's always something that's happening. This could be structured, but at the same time, you have $6 billion worth of properties last year. Currently, the market's already valuing them only at $2.9 billion. So you've already seen the market correct materially for these guys. Even though the FFO and the adjusted EBITDA are relatively stable, they can still cover the dividend, which is 8.5%, which is pretty high. So I'll have to see. I'll have to see how it reacts. So once they sell UDC, we'll see that both the obviously the property assets go down. We'll see the liabilities go down. Importantly, it'll be the higher interest debt liabilities, so we should see interest expense finally, at least this rate of increase will slow down. It'll flatline, hopefully. Now, a lot of them are fixed, but again, they have to roll them. But the maturity schedule is really spread out, so shouldn't hit them too much in a given year. And then obviously the assets to debt still pretty low, and they're selling for this UDC at a gain. Anyway, that's kind of what I talked about. It's always a fun thing, right? You're kind of ideal, like what needs to happen for this to work is occupancy needs to settle out at some point, preferably above 85%. Even there, though, at 85, you'll still probably be able to cover the dividend. They are saying it's supposed to go to 90, but again, you trusting management, so we'll have to see what actually happens, and especially over time, because there always is those kernels of truth. Like there will be less office space demand, and supply will have to react to that. It already obviously no one's building office buildings, right? So we'll have to see what happens over time. But in the meantime, we're going to see rents roll in certain companies. Like there are going to be some office REITs that struggle, right? So the point is to try to pick one that has least amount of debt with some type of catalyst to reduce the interest expense exposure and help the cap rate out a little bit. Or at least that's my thinking. And then if we do trust the occupancy, we'll go back over 90. Then that's also another nice de-risk, right? Because if this trend continues, it's not going to be good. Anyway, that's my thoughts on allied properties. There's a whole bunch in the office space, but this one had the fun thing with the UDC portfolio. So I wanted to get this video out before then because I think the deal closes in August. So today is July 30th, 2023. Anyway, have a great rest of your week.